All right, let's dive into what is, frankly, one of the most fascinating financial moves in tech we've seen in a long time. Alphabet's absolutely massive bond sale. And this isn't just about numbers, you know. It's a wild story about the future of AI, making 100-year bets, and what Google is fundamentally turning into right before our eyes.
So the number is just staggering. In early 2026, Alphabet, Google's parent company, hits the market and raises $32 billion. And we're not just talking about a big number here. This was a massive, historic deal done in multiple currencies that had pretty much the entire financial world buzzing.
But that brings us to the real mystery, the central paradox of this whole thing. See, Alphabet is already sitting on a mountain of cash. We're talking over $100 billion just on hand. So why? Why on earth would a company that loaded with cash go out and borrow another $32 billion? That's the puzzle we're going to piece together today.
Okay, so the very first clue to this whole puzzle, it all comes down to the absolutely insane cost of the global AI arms race. We're way past this just being about clever software now. This is about building the actual physical world that AI needs to exist in.
And the scale of what they're planning is just mind-blowing. Alphabet basically announced that their capital expenditure, CapEx, which is just a fancy word for what they spend on big physical stuff, could hit $185 billion in 2026. That's almost double what they spent the year before. This new debt, it's literally the rocket fuel for that ambition.
So what exactly is on that shopping list? I mean, what do you buy with that kind of money? Well, it's not just a few more servers in the back room, that's for sure. We're talking about locking down the global supply of the most powerful AI chips from NVIDIA, plus their own custom-built TPUs. We're talking about constructing these massive, sprawling data center campuses, laying new fiber-optic cables under the ocean, and get this, even investing in crazy next-gen tech like advanced liquid cooling systems and small modular nuclear reactors just to get enough power for the whole operation.
Okay, so fine, they need a ton of cash for a huge build-out. That makes sense, but that still doesn't explain the weirdest, most unusual part of this whole deal. This is where the story shifts from just spending money to making a truly epic, century-long strategic bet.
Because tucked away inside this giant bond sale was something you almost never see, a 100-year century bond. This was the first time a major tech company has done something like this since way back in 1996. I mean, just think about that for a second. They're borrowing money today that they don't have to fully pay back until the year 2126. That's a level of confidence in your own long-term survival that is just wow.
So why 100 years? What's the logic there? Well, it all boils down to a classic financial strategy called maturity matching. And the idea is actually pretty simple. You want to align the lifespan of your loan with the useful life of the thing you're buying. It's like you wouldn't get a 1-year loan to buy a house you plan to live in for 30 years, right? No, you get a 30-year mortgage. It just makes sense.
And that is exactly what Alphabet is doing here, just on a massive scale. They look at these huge data centers, the undersea cables, all this power infrastructure, and they don't see them as things that will be obsolete in 10 years. They see them as 100-year assets. So what do? They issue a 100-year debt to pay for them. It's a perfect, elegant match between their financial plan and their physical construction plan.
Now, raising billions of dollars is impressive, for sure, but the real magic is doing it cheaply. And this is where things get really clever, where some sophisticated financial engineering basically turned this huge pile of debt into what you could call cheap money.
To get how they did this, we need to quickly touch on a financial idea called duration. Don't worry, it's not that complicated. Basically, duration is just a measure of how sensitive a bond's price is to changes in interest rates. And the key thing to know is that a 100-year bond has the most extreme, the most sensitive duration you can possibly find. It's like a finely tuned instrument.
So you might be thinking, why would any investor want that kind of volatility? Well, for some, that risk is actually a massive opportunity. It's what's known as the duration play. Here's how it works. If long-term interest rates happen to drop by just 1%, the price of this 100-year bond could absolutely skyrocket. We're talking a potential gain of 40 to 50%. Now, if you're, say, a giant pension fund that has to worry about paying out pensions for the next 100 years, having an asset that does that when rates fall is an incredibly valuable hedge. It's a feature, not a bug.
And boy, did the market love this idea. The demand for these Alphabet bonds was just off the charts, completely overwhelming. They had actually planned for a smaller sale, but when the orders started flooding in,
topping over $100 billion, they realized they had a hit on their hands. They could ask for way more money and get much better terms.
This is where that insane demand creates this really cool effect for Alphabet called spread compression. Okay, so the spread is basically the extra bit of interest a company has to pay on top of what a super safe government bond pays. It's like a risk premium. But when everyone is clamoring to give you their money, that premium gets squeezed down or compressed because you're not seen as risky anymore. You're the popular kid. And that little bit of compression has a huge real-world payoff. Because demand was so high, the final interest rate Alphabet had to promise was pushed lower. And over the life of these super long loans, that tiny little change is estimated to save the company something like $500 million in interest payments. They essentially got a massive discount just because everyone wanted a piece of the action.
Okay, let's take a step back and put all the pieces together. We've got the crazy spending on AI infrastructure, we've got the audacious 100-year bet, and we've got the brilliant financial footwork to make it all cheap. So, what does it all mean? What's the big picture for the future of Google? This, right here, is the final and I think the most important piece of the puzzle.
What we're really seeing here is a fundamental identity shift. For decades, Google built its empire on being asset-light, right? It was all about brilliant software, search algorithms, digital ads, things that didn't have a lot of physical weight. But this is a hard pivot to becoming asset-heavy. The future they're betting on isn't just about code. It's about owning the physical foundation of the digital world, the data centers, the power grids, the raw compute itself.
And this quote really nails the heart of their 100-year bet. Alphabet is convinced that in our lifetime, access to raw computing power, compute, is going to become as essential as electricity or clean water. It won't be a luxury, it will be the basic, fundamental utility that powers every other part of the economy.
And that, of course, leaves us with one massive, critical question. If compute really is the new electricity, then who's going to own the power grid? Who will control the power plants? With this $32 billion move, Alphabet is planting their flag and making it crystal clear. They plan to be one of the owners. They're not just in the app business anymore. They're in the business of building the utility company for the 21st century.